Welcome to another video of tradingshiksha.com. In this video, I would introduce you to bonds. The flow of video would be like this. First, we will start by looking at the importance of bonds, then definition of bonds, terms associated with bonds, yield to maturity, relationship between bonds and interest rate, and at last we will look at valuation of bonds, which is our main objective of this video. And for this only we need to understand all these things. So why we need to understand bonds, or what is the importance of bonds? Bonds are very important part of monetary policy. Bonds can be used by the central bank to infuse money or reduce the money supply in the system. Central banks also use bonds for controlling the interest rate in the market. What is a bond? Bond is a debt investment in which an investor loans money to an entity which borrows the funds for a defined period of time at variable or fixed interest rate. There is a bond issuer and bond buyer, or also the bond holder. The bond issuer borrows the money from the bond holder. In return of this, the bond issuer pays the holder of bond interest periodically, and at the end of the tenure of the bond, it also pays the principal amount. This is very much similar to the loan which we take from the bank. The only difference is that the loan which we take from the bank, we have to pay the EMI, and the EMI is consisting of both the interest payment and the principal payment. While in case the bond is issued by the government, generally the interest is paid periodically and the principal amount is paid at the maturity. Now let us look at the various issuers of bonds. Supranational organizations such as World Bank, IMF, etc. Sovereign governments such as United States, Japan, India, and sovereign governments are the largest issuer of bonds, and the bond which are issued by the sovereign government are considered risk-free, and they set the benchmark rate or the risk-free rate in that country. Then non-sovereign governments such as state of Minnesota in United States or region of Catalonia in Spain also issue bond. Quasi-government entities such as the postal services in many countries can also issue bonds, and at last the companies also issue bonds. Companies can either raise money through issuing debt or equity. By debt, they borrow money, and equity, by raising money through equity, they make shareholders. And the companies raise money through debt, that is, they issue bonds. Now let us look at the terms related to bonds, and this would be helpful in understanding the valuation of bond. The first term is the tenor. Tenor is also known the term to maturity, and it is the time remaining until the bond's maturity. For example, a bond which is issued say in September 2016 and it is having maturity in September 2018 will have a tenure of 2 years, because the time left to the maturity is 2 years. Next term is the par value. The par value is the principal amount that is paid by the issuer at the maturity of the bond. For example, the par value of a bond is 100. So this means that when the bond expires, the issuer of the bond will pay 100 rupees to the bondholder. The last term is the coupon rate. Coupon rate is the interest rate that the issuer pays on the bond, and this coupon rate is fixed at the beginning when the bonds are issued, and this remains constant over the term of the bond. This coupon rate. We now take an example in which we cover all these terms. Now in the example, company A issues a bond which is having a par value of 1000 rupees. Now this, as I explained you, this means that the company will pay the bondholder 1000 rupees at the end of the at the maturity of the bond. Next is the issue price. Issue price, every bond has a price, and once issued, the bonds are traded in the secondary market or the stock market, and the price of the bond is variable. The par value and the coupon is fixed over the term, but the price is tradable in the stock market and it fluctuates. So at the beginning there is a issue price, and in this example the issue price is equal to the par value. The coupon is 5% and it is paid annually. Coupon can also be paid semi-annually, quarterly, monthly, or any time, any period. The maturity of the bond is in September 2018, and currently we are assuming that the current time is we are in September 2016, so the tenure of the bond is 2 years, and this is the YTM or the yield to maturity. It is 5%, and we will see how this is calculated later in the video. But one thing, this YTM is equal to the coupon in this example because the bond is issued at the par value, or the issue price is same as the par value. We will see this more in detail later in the video. Now we come to yield to maturity. Yield to maturity is the total return anticipated on a bond if the bond is held until the end of its lifetime or until the maturity. So you must be thinking that this yield to maturity should be equal to the coupon rate, because the return which the investor is getting is basically the coupon or the interest. But we study this separately. Why? This is because first, we can buy the bond also after the issuance, and we can buy from the stock market at a price which is different at the at a price which is different compared to the par value. And if the issue price is different, then the YTM would also be different. We will see YTM in more detail later. Now we see the relationship between the interest rate and bond price. Note, the interest rate which we are talking is the market interest rate, because as I told you, the coupon rate or the interest rate on the bond is constant over the term of the bond, and it doesn't change. But the market interest rate, which is set by the central bank, changes over the term of the bond. So in this we are seeing the relationship between the market interest rate and the bond price. Now I would explain this with an example. Suppose there is a bond which initially the example would be the same. There is a bond which is having a par value of 1000 and it is issued at the par value 1000 rupees and it is paying 5% coupon rate. Now let's say after 1 year of issuance, the market rate the market rate is now increased to 6%, or the central bank has increased the interest rate to 6%, but the bond is still paying 5% interest rate, or the coupon rate which the bond is paying is still 5%, as the coupon rate of the bond is fixed over the term. So would anyone like to hold this bond? Obviously no, because the market rate, or he can get 6% easily by investing in the government bonds. So why will he hold this bond which is paying just 5% or lesser than the market rate? So they would start selling this bond. If they start selling this bond, its price would reduce and its price would fall until the YTM would be equal to the market rate, which is 6%. So the price would fall until the YTM becomes equal to the market rate. So when the coupon rate is less than the market rate, this coupon rate is the coupon rate on the bond which is issued by the organization. So when the coupon rate is less than the market discount rate, the bond is priced at discount below the par value, and this is what I explained to you right now. When the coupon rate is greater than the market discount rate, the bond is priced at premium or above the par value. This again I would explain in this example. Now instead of increasing the market rate, the central bank reduces the market rate. Now it reduces the market rate to 4%. Now the market rate is 4% and this bond is paying 5%. So what will happen? People will get more interested in this bond as it is paying higher interest. They will buy this bond and its price would increase. Its price would increase until the YTM becomes equal to the market rate, which is 4%. So when the coupon rate is greater, as in this example the coupon rate is 5% and the market rate is 4%, so the price of the bond would be higher than the par value. Now the last case is when the coupon rate is equal to the market discount rate, the bond is priced at the par. Obviously when the market rate is equal to the coupon rate, then the return which the investor is getting is same in whether he invest in the at the market rate or in the bond. So he will neither sell or buy that bond, and the price of the bond will be equal to the par value. We will understand this mathematically in the valuation of bond, so don't worry if you have not understood this. Now we look at the valuation of bonds. There are two ways in which the investor can earn through bonds. First is the price appreciation and second is the coupon payment. As I told you, if the market rate market rate of interest rate declines and it falls below the coupon rate given on the bond, the price of the bond will rise. So the investor would gain through the price appreciation. If the price remains constant, then the investor would earn through the coupon payment. Now we look at the mathematics and we see how the price is actually determined. So there is a bond which is paying coupon C, or this is like this can be calculated as like coupon rate into the par value. We will get the coupon payment. N is the number of payment, I is the market interest rate, and M is the value at maturity, or the par value, or the principal which the issuer will pay at the maturity. So price of a bond is equal to the present value of its future payments. So whatever future cash flow, we just discount that at the market interest rate, and we get the bond price. What is the fundamental bond price and what is the value it should trade in the stock market. Let us understand this with an example. Now one thing more, this coupon rate is fixed. I am repeating the point again and again. The coupon rate of the bond is fixed throughout the term of the bond, and the interest rate, the market interest rate, fluctuates during the term of the bond. The maturity, the par value is also fixed, and the tenure is also fixed. Now you can find this calculator online, and the variables in this calculator are the present value which we are calculating in this example, the future value is basically the par value of the bond, the payment or the coupon is the periodic interest payment on the bond, the time to maturity, or this is also the equal to the tenor, and this is the market interest rate. So to calculate the present value, we need all these value, or to calculate future value, we need all the other four values. So one value will be variable while calculation, and other would be given. Now in these I would take 3 examples, and in all the 3 examples I would calculate the present value of the bond. The present value of the bond would be the price of the bond at which it would be traded in the stock market. And here you will also get the concept of YTM. So in this example, we take a bond which is paying a coupon rate bond which is at discount to the market rate. Now when will the bond be discount to the market rate? Obviously when the market rate or the market interest rate would be higher than the coupon rate. The coupon rate in this example is 4% and the market rate is 6%. I explained this. The market rate is higher than the coupon rate. The tenure of the bond is 5 years, or 5 years is left to maturity of the bond. The par value is 100. So what will be the cash flow? We will receive 4 rupees, which is the interest at end of each year, and in the last year we would receive the interest plus the principal, which is 104. Now we discount each of this cash flow using the market interest rate, and we will get the price of the bond or the present value of the bond. You can easily calculate these things using the calculator, and if when you calculate you get the present value as 91.575. So the bond coupon rate is 4%, and it may be the case that when it is issued it is issued at 100 rupees, but now after some time the market rate has increased to 6%, so the bond price would fall to 91.57. And you can also understand it the other way. When the market rate is higher than the coupon rate, people would not prefer to hold that bond and basically sell that bond, and the market rate would fall to 91.57. At this price, the yield on the bond would be equal to the market rate, and so they would now, since the yield on the bond is equal to the market rate, the price would stabilize. Now if you are unable to understand yield to maturity, you can see in this way. As I told you, these are the 5 variables, and if you know value of 4, you can calculate the value of the last variable. So in this example we took these things as given and we calculated the present value. But if we knew the price of the bond, which we can see on the stock market, because it is traded on the stock market, you can easily calculate the yield on the bond, which will be the market interest, which should be equal to the market interest rate. So the price, if the coupon rate is less than market rate, the price will fall until the YTM becomes equal to the market interest rate. Similarly, in this example we will take an example which is trading a bond, example of a bond which is trading at a premium to the market rate. So if it is trading at the premium to the market rate, the coupon rate on the bond should be higher than the market rate, then only it can trade at premium. So the coupon rate on the bond is 8%, the market interest rate is 6%, which is less than the coupon rate. The par value is 100, the tenure is 5 years. So we can derive the cash flows. The yearly coupon will be 8% of the par value, which is 8 rupees, and in the last year we will receive the par value or the principal value plus the coupon, which is 108, and we have to discount these cash flow at the market rate, which is 6%. So when we discount this back and add them, we get 108.425. So again, if the bond may be issued at the par value, but later the market rate when the bond is issued at the par value at the issuance, the market rate would be the same as the coupon rate. But now later the market rate has fallen to 6%, so the price of bond would also change from 100, and obviously since the market rate has fallen and the coupon rate is still 8%, the demand of the bond will rise and its price would rise, and its price would rise until the yield on it is equal to the market interest rate. Now last case is the bond which is trading at its par value. So the coupon rate on the bond is 6%, the market rate is 6%, the par value is 100, and the tenor is again 5 years. So the coupon payment would be 6% of 100 is 6%, and at the end, that is the 5th year, we would get the par value plus the coupon payment, which is 106, and we discount this back these cash flow at the market rate, which is also 6%, and when we add these present value of the cash flow, we get 100 rupees. So I hope you understood YTM and this 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 price this valuation of bonds. Now we discuss some special type of bonds. First is the zero coupon bond. Now zero coupon bond is a bond which pays no interest. So why would any investor buy it? Obviously there are two ways through the by which the investor can earn. First is the price appreciation, second is the coupon payment. Since this bond is paying no coupon, the only way the investor can earn is through price appreciation. So at issuance, this bond would be issued at discount to the par value. Means, say the par value is 100 rupees and the bond is issued at 98 rupees. So when a buyer would buy that bond, it has to pay 98 rupees, and at the maturity he will get 100 rupees. So the difference, the 2 rupees, would be his return. And this point is already explained. It is generally issued at discount to the par, and generally the shorter term bonds which is having shorter maturity are zero coupon bonds. There is one more type of bond, special type of bond, which is the perpetual bond. A perpetual bond is a fixed this is I copied from somewhere, but this means basically that a perpetual bond is a bond which is having no maturity date. So since it is having no maturity date, there will be there will be no payment of the principal, and it would be paying the interest for a indefinite period. Means always it will be a cash flow which will last for a infinite period of time. So they will keep paying interest coupon indefinitely. And how will we get the price of the perpetual bond? Here is the formula. The formula is present value of perpetuity is equal to the dividend or coupon per period upon the discount rate. Discount rate is the market rate, and this is the periodic interest payments which the bond issuer is giving. Now example of a perpetual bond: suppose a government issues a perpetual bond which pays a coupon of $10 $10, and this would be for infinite time, and suppose $10 per annum annually, and the market interest rate is 5%. So the present value of that bond would be 10 divided by, we convert this percentage into decimal, and 10 divided by 0.05, which is equal to 200, and present value is 200. So the price at which it would be trading at the stock market would also be 200. Now I finish with the example. I hope you have understood how we calculate the price of the bond, and this price of the bond would be equal to the price at which it would be trading at the stock market. Now we will see the live example, and this is the screenshot which I have taken from the NSE site, National Stock Exchange India. You can see these government bonds are traded, and like this is this is the symbol of a government bond, and if you see this bond 77 to this means this symbol also tells the feature of the bond. So this bond will expire in 2025, and its coupon rate is 7.72. So, and the yield which the current yield on it is 7.09. So again I am revising the concept. The yield is lower than the coupon rate, so it should trade at discount or premium. It should, since the coupon rate is higher than the market rate, it should trade at a premium. And you can see here the last traded price is 103. Obviously the par value would be 100 rupees, and it is trading at 103.95, and the yield is this much. Now I told you that the central bank use these bonds to control the interest rate in the market. So we can understand now how they use the bonds to control the interest rate. Now suppose the yield, which is also equal to the market interest rate, is 7.09%, and now RBI wants to reduce it to say 6%. So what they have to do, they will just go to the market. They can just, they have an option. If they want to reduce this interest rate through bond buying, they can just go to the market and buy that much amount of bond which will reduce the price, sorry, which will increase the price, and the yield on the bond would fall. When the yield would be equal to 6%, then they can stop buying that bond, and they can easily do this. So friends, in this video only this much. If you found this video interesting and informative, you can subscribe to our channel, and you can also visit to our site, that is www.tradingshiksha.com. Thank you.